So, the big news story this week in the precious metals market is that the Trump administration is considering tariffs on the import of large gold bars from Switzerland. Let me read you this article from mining.com. The United States has imposed tariffs on imports of 1 kilogram and 100-ounce gold bars in a move that could disrupt global bullion flows and deal a major blow to key gold hub Switzerland. The Financial Times reported late on Thursday. A Customs and Border Protection letter dated July 31st, later seen by Financial Times sources, shows that these gold bars have now been reclassified under a customs code subject to duties, reversing earlier expectations that they would remain exempt. The tariff reversal comes amid heightened trade tensions between Bern and Washington, as the latter recently slapped a 39 import tariff on the European nation. Switzerland, as the world's top gold refiner, shipped about 61.5 billion worth of gold to the United States in the year to June, of which roughly 24 billion could now incur tariffs under the new tariff rate, according to FT estimates. Industry sources told the paper that some Swiss refineries have since suspended or reduced shipments to the United States while seeking legal clarity on product classifications. Christoph Weil, president of the Swiss Association of Manufacturers and Traders of Precious Metals, said the tariff represents another blow to Switzerland's trade with the United States and would make it difficult to meet demand for the yellow metal. The kilo bar is a key unit traded on New York's Comex exchange, which is the world's largest gold futures market and holds the bulk of Switzerland's bullion exports to the United States. Meanwhile, the London markets typically deal in 400-ounce bars. The tariff decision comes as gold prices have climbed 27% in 2025, driven by inflation concerns, rising government debt, and a weaker US dollar. In order to illustrate the importance of this event, I want to show you a chart of the premium of gold futures compared to the spot price. It has just set a high of over 3.5%, the likes of which we haven't seen since the onset of COVID in early 2020. If we look at the price action of the futures, we'll see that there was an initial spike in the price, but later it was reversed and it closed pretty much flat on the day. And the reason for that is probably that the White House is trying to walk back that announcement. We have here an article from Bloomberg which says that White House to clarify gold tariffs after ruling sparked chaos. The Trump administration suggested it would issue a new policy clarifying that imports of gold bars shouldn't face tariffs after a U.S. government agency stunned traders by formally ruling that they'd be subject to duties. The administration intends to post an executive order in the near future to clarify what it called misinformation about the tariffing of gold and other specialty products, a White House official told Bloomberg in a written statement. The official detailed the plans Friday on condition of anonymity. Now, it could be that the White House is using the threat of tariffs as a negotiation tactic in order to scare Switzerland into submission, as we've seen them do in the past, and that they never intended to keep these tariffs in place. It could also be that the White House doesn't really understand the importance of gold in the global financial system, and that they were shocked by the market's reaction, and were forced to do an about-face. We don't know for sure. But even the threat of tariffs can upend the entire gold market. As we all know, the prices of the precious metals are being managed by the large banks. If you wish to purchase a long futures contract, they will be happy to sell it to you, even though they don't have enough physical metal to satisfy all of those contracts. This way, they can create the appearance of an abundance of supply and keep the price in check. They rely on the fact that most traders do not stand for physical delivery and instead choose to settle in cash at the end of each month. Only a tiny fraction of the contracts which are traded on the Comex end with physical delivery, but the entire legitimacy of the commodity exchange hinges on its ability to deliver physical metal. If a tariff on gold bars from Switzerland will prevent it from meeting its obligations, then the legitimacy of the exchange will be called into question, and the futures price will become irrelevant. This will incentivize more people to hold physical gold rather than paper gold, and can eventually lead to a short squeeze. Thus far, these news did not affect the retail market significantly. Online bullion dealers are still offering 1 kilo gold bars, and the premiums did not increase. It appears that cash-strapped Americans are selling their bullion, and there is enough supply from the secondary market to satisfy the retail demand. But we need to see how things develop in the coming weeks and months. Moving to the technical charts, gold is still consolidating in a pennant formation. 2 weeks ago, it appeared to be breaking down from an important rising trend line, which gave it support since the beginning of 2025. For a while there, we were concerned that this breakdown will send it all the way down to $3,000 an ounce. But as you can see, it managed to find support and rebound. Right now, it appears to be retesting this broken trend line from below. An important principle in technical analysis is that broken support becomes resistance, and vice versa. So in order to advance, the price of gold needs to surpass this line and the horizontal resistance at $3,440 an ounce, a level which for some reason held it back 3 times before. Similarly to gold, silver broke down from a rising trend line and is now retesting it from below. In order to move higher, it needs to retake this line and the one right above it. This is the resistance line which connects all the tops since the beginning of 2023. If gold manages to break out, I am confident that silver will follow. I want to end this short update by reading you a post I made on X about the danger of herd mentality and groupthink. We don't like to think of ourselves as herd animals, but we are. Most of us are not intelligent enough to figure out what needs to be done, so we just follow everyone else, and in 9 cases out of 10, that's the best thing to do. But once in a while an event comes along which most people get wrong, and doing what everyone else is doing turns out to be a painful mistake. And once in a century, an even bigger event comes along, which is absolutely devastating to the herd, and will leave most of them impoverished, or perhaps even dead. To survive such an event, you need to have independent thought, and the mental fortitude to act upon your conclusions, regardless of the signals which society is giving you. If you get it wrong, no one will take pity on you. After all, you have strayed from the herd's path, and your failure only reassures their herd mentality. But if you get it right, the reward will be princely. You will be one of the few with some capital left after everyone else has been wiped out. You will be able to purchase profitable assets for pennies on the dollar and participate in the reconstruction efforts which will follow. Your wisdom and foresight will become legendary, and everyone will respect you and seek your counsel. We are probably getting near to such an event. And if you are reading these lines, you know of what I speak. Get yourself some physical silver. Before we say goodbye, I need to read you my disclaimer real quick. Remember that I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.